Thanks for watching the final installment of the series Is Value Investing Really Dead? In this video, you will be able to see how value investing has evolved from the early days where value investing is strictly focused on finding cheap companies to the current modern day where Warren Buffett and all other successful value investors focus on investing in companies which are good and you can purchase them below how much they are worth. When Warren Buffett stopped working for Graham and set up his own investment partnership, he achieved great success by investing in cigar butt type of stocks, which is an investment style that was close to what Graham was preaching. However, all that started to change slowly when Buffett met Charlie Munger for the very first time in 1959. Munger was a lawyer when he met Buffett but was hooked onto investing when Buffett started sharing some of his adventures in the stock market. Eventually, Munger set up his own investment partnership in 1962. It lasted 13 years, during which Munger achieved an annualized return of 19.8%, trashing the Dow Jones returns of 5% per year. But even though Munger first got acquainted to investing through Buffett, he ran his partnership with a different sort of view. Munger was on the lookout for great businesses, which means businesses that could grow their profits at above average rates for many years, making their owners wealthy. And this thinking was influenced by another investing legend whose philosophy could not be more different than Graham's. Let's meet Philip Fisher. Fisher was the author of an important book on investing titled Common Stocks and Uncommon Profits. Buffett values Fisher's thinking so much that he has said Common Stocks and Uncommon Profit is a book that ranks only behind The Intelligent Investor and the 1940 edition of Security Analysis. While Graham was famous for appraising a business' intrinsic value based mostly on its balance sheet and believed in diversification, Fisher instead looked at the business' qualitative factors and believed in making concentrated bets. Fisher was an investor who wouldn't mind paying high prices for a stock he believed in its growth potential, whereas Graham was looking at how much a stock would be worth if the company was liquidated. While Fisher was known as a growth investor, he actually had a huge part to play in shaping the modern view of value investing that Warren Buffett is more widely recognized for. So let's take a look at what's arguably the most important aspect of Buffett's interpretation of value investing. On modern-day value investing, Buffett looks for companies with an economic moat as a protective barrier to a company's above-average profit, much like how a real moat protects a castle from invaders. In the capitalist world, companies that earn high profits will likely attract competitors. The more competitors there are, the lower the profits the original company can earn. In reality, there are companies who have successfully prevented competitors from taking away the profits, and that is due to the presence of an economic moat. Moats can come in many forms, and in Pat Dorsey's book titled The 5 Rules for Successful Stock Investing, it contains a great framework to think about economic moats. And this brings us to another criteria that Buffett focused on, the return on equity, or ROE for short. Buffett liked companies to demonstrate consistently high ROE as a sign that there is something that's able to protect the company's above average profits. If ROE is 15%, it simply means that for every $100 of capital or equity, it has generated a return or profits of $15. In essence, ROE and the presence of an economic moat helps to differentiate a great business from a bad business. That's the main difference between Buffett's thinking and Graham's form of value investing. Graham never sought to find out if a business was better than its competitors or not, whereas Buffett eventually placed a lot of emphasis in investing in companies that are not above their competitors. Buffett believed that investing in such companies will prove to be a lot more profitable than investing in statistically cheap companies over long stretches of time. Perhaps the best summary on how Buffett has evolved as a value investor could be summarized in this quote. It's far better to purchase a wonderful company at a fair price than a fair company at a wonderful price. Graham would have preferred a fair company at a wonderful price, and that was how Buffett got started. But over time, Buffett would become the well-known investor he is today by buying a wonderful company at a fair price. Value investing has indeed evolved a lot from Graham's thinking to Buffett's current philosophy. But the greatest takeaway among their very different approaches is their insistence on studying stocks as a piece of a business. Value is a subjective measure, as can be seen from Graham and Buffett's differing views on it. Charlie Munger, the Daily Journal chairman and Berkshire Hathaway vice chairman, had gave his take on value investing. He said, "Value investing, the way I conceive of it, is always wanting to get more value than you pay for when you buy a stock. And that approach will never go out of style. I think all good investing is value investing. It's just that some people look for values in strong companies while some look for values in weak companies. Is value investing really dead?" Thank you for watching this 3-part series, and if you wish to learn more about value investing to grow your money safely and consistently, please grab a copy of my latest book titled Value Investing Simplified, where you can learn value investing in a simple and fun way. I would also like to thank Miss Laura Templeton, the author of the best-selling book Investing the Templeton Way, for writing the foreword inside this book. So remember to click like and subscribe to our VIA channel to learn more about value investing. And I shall see you soon. Goodbye.